There are a lot of loan officers in this business who think they have a lead problem. They think they need more ad spend. They think they need better realtors. They think they need more calls. They think they need more referrals. They think they need a better script. They think they need a better CRM. Maybe it's visibility that they think they need, or potentially it's just creating more content. They think they need more opportunities. And guess what? A lot of times that may be true. But there's sometimes that it's not the problem at all. A lot of times the real problem is much simpler. They're seeing opportunities every week that they do not know how to recognize. They're talking to borrowers every month they do not know how to structure. They're being introduced to transactions all the time that they lose. And it's not because the borrower doesn't qualify, but because the originator only knows one particular lane. And that ends up being the real issue. They know the clean conventional borrower. They know the easy government file. They know the neat W-2 employee with predictable income history, the straightforward documentation, and the clean path through underwriting. But once the borrower steps outside of that lane, the LO starts running out of answers. And if that's you, your business is a lot smaller than it should be. And it's not because the market is broken, or because the clients are bad or not qualifiable. It's not because the opportunities just aren't there. It's simply because product knowledge is too narrow. I'm Dustin Owen, and this is the DO Show. They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built a $1 billion mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to the DO Show, where I teach the lessons life taught me the hard way. This episode is going to be about helping you become a better originator, build a stronger business, and think at a level that separates you from the average person in this industry. And today, we are talking about one of the biggest opportunities sitting right in front of a lot of loan officers that they still do not fully understand. And that's non-QM. And I know what you're saying. I feel like we've been talking about non-QM for 5 years. We have. Yet so few are actually originating non-QM on a consistent basis. Therefore, we have to do a deep dive. So most specifically, let's understand that non-QM loans can absolutely increase your units and volume funded. It can expand your value with your referral partners. It will create opportunities that many originators are still letting pass by. Now, before we go any further, let's clear something up. Non-QM does not mean bad lending. It's not subprime lending, y'all. It does not mean sloppy lending. It does not mean we are going backwards. It does not mean you throw underwriting out the window and just start approving whoever has a pulse or walks in the door. That's not what this is. Some of the most qualified, capable, successful borrowers you will ever speak to are not clean conventional borrowers. They are self-employed. They are 1099. They own businesses. They write things off. They have strong deposits, but less attractive tax returns. They're investors. They're people who are rich in assets. They are between income events. They may have a complicated story, but not a weak one. And if you only know how to qualify people in the most traditional format, then a huge part of the real world is going to look invisible to you. And when I say a huge part, I'm talking 20 to 30%. That is where non-QM becomes such an opportunity, because the average loan officer hears a conventional no and thinks the file is dead. The better question that loan officers should be asking is the smarter question. Is this borrower actually unfinanceable? Or do they just not fit in the first box I tried? That is the whole episode right here. That question alone can change your business. Because most originators are not losing all these deals because they are bad salespeople. They are losing them because they do not know enough. They haven't found their find a way to yes mentality. They do not know the lanes. They do not know the borrower profiles. They do not know the structure options. They do not know how to identify a misfit file versus a dead file. And if you want to close more loans in the years ahead, you need to fix that. So let's talk about the core non-QM buckets that every serious full-time originator should understand. Let's start with the one that probably opens the most eyes for the average loan originator, and that's bank statement loans. This is one of the clearest examples of where good borrowers get lost unnecessarily. You have somebody who owns a business. Maybe they are a contractor, maybe they own a marketing company, maybe they are a consultant, or they own a brokerage, or they run a service business. Heck, maybe they're even a doctor who owns their own practice. Maybe they are an entrepreneur with strong revenue and real cash flow. You can see they're successful. You can see money moving. You can see stability. You can see deposits. You can see the business is real. But then they hand you the tax returns. And those tax returns, well, they look weak. Why? Well, because they're doing what business owners do. They're deducting expenses. They are managing tax liability. They are running the business intelligently from a tax standpoint. Now, the average originator sees that and says, I'm sorry, the income does not work. And that is where the opportunity dies. But the better originators understand that taxable income and true cash flow are not always the same thing. That borrower may not fit the traditional tax return method. That does not automatically mean they cannot qualify under a different framework. That is where bank statement loans matter. Because now, instead of only staring at tax returns, you are evaluating the borrower through a different documentation lens using bank statement history, cash flow patterns, and program-specific methods for assessing income. Now, all of a sudden, the self-employed borrower that would have been lost has an actual path. This is your way of finding a way to yes. And you need to understand how important that is. Because self-employed borrowers are not some tiny niche corner of the market. They are everywhere. Business owners are everywhere. Entrepreneurs are everywhere. Independent earners, well, they're everywhere. And a lot of them know the same thing about mortgage lending. Most loan officers do not understand them. That's the opportunity. If you become the originator who understands how to structure the self-employed borrower, you do not just get one deal. You become referable to an entire type of person. That borrower refers you to another business owner. That business owner refers you to another one. Their CPA hears your name. Their financial advisor hears your name. Their realtor will 100% remember your name. And suddenly, you're not just another lender. You are the lender who knows how to handle the self-employed borrower. And all of that matters when you're playing that game of chess and not checkers. Now let's jump into the investor side of things. We're talking DSCR loans, debt service coverage ratio. This is another major lane that can dramatically expand an originator's business if they actually understand how to talk about it in the right way. Because investors do not always think like primary resident buyers. They are not always leading with personal income qualification. They are not always emotionally attached to the home. They are not always asking, how do I fit this into the prettiest conventional approval? A lot of times they are asking a totally different set of questions. What's the rent? What's the payment? Does the property cash flow? How does this impact my portfolio? How can I scale with this type of structure? Can I close fast enough to compete? Does this fit my investment strategy? And that's not the same conversation that you have with that person buying their primary home. And one of the easiest ways to sound inexperienced with investors is to try to force every investor conversation into a framework that was designed for those buying primary homes. It kind of misses the point. A DSCR loan lets the conversation revolve around the income producing ability of the property itself relative to its debt obligation. That is why it is such an important tool, because now you have a path for investors whose tax returns may be a little messy, whose personal income picture may not tell the whole story, or whose strategy is built around the asset itself. And investors are incredibly valuable relationships. Why, you may ask? Well, because good investors are often repeat clients. A lot of owner-occupied clients may only transact every 7 to 10 years. A real estate investor may buy one property every single year. A real estate investor may refinance strategically. A real estate investor may bring multiple properties over at a time. A real estate investor may refer other investors. So understanding DSCR is not just about saving one deal. It is about opening up an entire category of repeat business. Now let's talk about another type of non-QM loan, and that's a asset depletion type loan. This is one of those areas where rigid originators miss strong borrowers because they only know how to look for income in one format. You have a borrower with substantial assets. They have liquid money. They have retirement assets. They have brokerage assets. They may have sold a company. They may have stepped away from active work because maybe they're semi-retired or even, heck, fully retired. They may be living from wealth, not wages. And because they do not fit a traditional paycheck model, the average originator gets confused. And that's a big mistake. Heck, even their financial advisors get confused and don't think they'd qualify for financing. Some of the strongest borrowers you will ever meet are strong because of balance sheet strength and not because of monthly payroll. Agency lending itself recognizes some asset-based qualifying approaches in certain scenarios, which definitely helps, but they don't help in every facet. Now, every program is different, every lender is different, and you still have to understand exact guidelines and calculations. But the larger lesson is simple. Do not confuse lack of traditional employment income with lack of financing strength. That borrower may be highly financeable. They may just need a product that looks at the whole picture differently. That's what I call non-QM thinking, or finding a way to yes thinking. Now, the cool thing about some non-QM loans is they have interest-only options. Now, shallow originators, they may think this is foolish. They hear interest only and instantly act like it's reckless. They hear non-QM sometimes and assume somebody has low qualifying standards. They hear alternative documentation and they think the whole file must be weak. And that's not expert thinking. Expert thinking is about fit. Payment structure matters, liquidity matters, strategy matters, borrower profile matters, reserves matter, exit strategy matters, and case use matters. For the right borrower, especially one managing cash flow, business income, or investment strategy, an interest-only feature can create a structure that better aligns with how they want to operate. That does not make it automatically right. It makes it something you should understand. And that's the point. A true professional does not dismiss products emotionally. They evaluate them intellectually. Then you have the broader category of alternative documentation loans. This is important because if you only hear bank statement and DSCR, you can still miss the bigger picture. Non-QM is not one product. It is not one trick. It is not one exception. It is a category of lending solutions designed for borrowers whose financial profile does not fit standard QM or qualified mortgage and agency methodologies. That may include 1099 income approaches. That may include P&L supported structures. That may include alternative ways of documenting a self-employed borrower. That may include scenarios where the borrower is strong, but the paper trail does not line up in a conventional way. It may mean that the person is a foreign national or that they're here on a certain work visa. And listen, the more you understand, the more dangerous you become in a good way. Because now when a borrower calls you, you are not just hearing a file, you are hearing a profile. You're not hearing a story. You're hearing their story. You're hearing clues. You're identifying which lane might make sense. That's what experienced top producing originators do. And then there's the borrower with a recent credit event or a non-traditional credit story. This one should always be handled carefully and honestly. The point is not to promise approvals. The point is to act like every bankruptcy, foreclosure, short sale, or rough chapter has a magical answer. The point is not to shut the door too early. Too many LOs hear one negative credit event and mentally quit. But a disciplined mortgage lender asks better questions. How long ago did it happen? What caused it? Was it isolated or part of a bigger platform? What has changed since? What do the reserves look like? Was there an extenuating circumstance? Is there any payment shock? What compensating factors may exist? What's the full story? like the questions behind the questions. And again, not every borrower has a path, but some do. And that is enough reason to know the lane. Now let's get to the title itself. Why can non-QM double your closings? Right? That's how we started this thing. It is not because every deal becomes a non-QM deal. It is not because you suddenly approve everybody. It is not because you stop caring about risk. It is because your field of vision gets bigger. You start finding a way to yes. That is what happens. If all you know is conventional FHA, VA, or the cleanest version of those products, then your closings are capped by the number of borrowers who fit that lane. But once you add non-QM understanding, now your pipeline includes self-employed borrowers. It includes borrowers with strong deposits. It's people that are looking for a DSCR loan because maybe they're asset rich or they're investors. It's people that need alternative documentation. It's people who need a strategic payment structure that's going to help them find their way to yes. That is a meaningful expansion of your opportunity. And all of this matters even more because most loan officers are still not strong enough here. That means product knowledge becomes a competitive edge. When a realtor knows you understand self-employed borrowers, you become more valuable. When a CPA knows you know how to think through business owner clients, you become more valuable. When a financial advisor knows you can handle an asset-heavy client, you become more valuable. When investors know you speak their language, guess what? You become more valuable. And in this business, useful wins. It always wins. Not louder, not flashier, not more social posts, no more slogans, just more useful. That is what creates referrals. That is what creates trust. That is what creates repeat business. That is what creates a business that survives changing markets. But let me be equally clear about something else. Knowing non-QM does not mean throwing non-QM at every hard file. That is not intelligence. That's just a different kind of laziness. A real expert knows when to keep the borrower in an agency loan. A real expert knows when FHA is still the right answer, when VA is still the best fit. A real expert knows when conventional still wins. A real expert knows when non-QM is the right tool, and more importantly, which non-QM lane fits the borrower best. That is the difference between a product pusher and a true advisor. And the best originators, guess what? They are advisors. They're not rate quoters. They're not just emailing a checklist, and they're not waiting for AUS findings to let them know whether or not they have a real loan. They are scenario managers. They understand the borrower. They understand the purpose of the loan. They understand the strengths in the file. They understand the weak spots. Yeah, they understand the weak spots. They understand the structure options. Then they place the borrower into the right lane. That is what clients pay for. That is what referral partners remember. That is what creates the moment when a realtor says, send me the hard files too. This person actually knows how to think. And that is where your business really changes, because easy deals are available to everybody. But the moment you can confidently handle the borrower who does not fit the standard box, your value goes up. Now, you are not just one more lender in the market. Now you are somebody who can preserve transactions. You can, reopen an opportunity. Now you are somebody who can speak intelligently to more borrower types than just that average originator. That is how closings grow. That is how trust grows. That is how your business becomes harder to disrupt. And I want to stay on that for a minute, because this is the part many people miss. Non-QM is not just about products. It's about perspective. It is about whether you stop at the first no. It is about whether you understand the difference between a weak borrower and a borrower with non-traditional documentation. It is about whether you can identify the right tool instead of just the familiar one. It is about whether you are willing to grow beyond the easy lane in the business. Because once you do that, the world changes. You stop treating self-employed borrowers like they're a pariah. You start seeing them as an opportunity. You stop treating investors like they have the cooties, and you start seeing repeat business. You stop treating asset-heavy borrowers like a confusing file that you don't know what to do with, and now you start seeing that the balance sheet is a strength and they are qualifiable. You stop seeing every non-traditional story as a red flag, and you start seeing a scenario worth evaluating. That's a shift in mindset. And that shift alone can create a lot more fundings over time. So here's the challenge. If you have been treating every borrower who falls outside the conventional lane like a dead end, stop. Start asking better questions. Is this borrower actually weak, or do they simply not fit the first product I'm aware of? Would bank statements tell a better story? Is this person better fit for a DSCR loan? How about if we utilize an asset depletion loan? Is this a better fit for alternative documentation? Is there a strategic structure that aligns better with how this borrower actually lives and earns? Because listen, the opportunity is already there. It is in your database. It is in your pipeline. It is in your realtor relationships. It is in the borrowers who got told no by someone else. It is in the referrals you never converted because you did not know what lane to reach for. That's why non-QM matters. Not because it is exotic, not because it is trendy, because it helps serious originators serve more real-world borrowers responsibly. And the originators who learn that, well, those are the originators that are going to close more. They're going to protect more relationships, create more repeat business, and become much harder to replace in the years ahead. That is the goal. So learn the lanes, learn the borrower profiles, learn how to diagnose, learn how to think, learn how to match the right solution to the right scenario. The loan officer who understands non-QM is not just another lender. They are a problem solver, and problem solvers win. Y'all, if you like this episode, subscribe to our YouTube channel for more content that helps you grow as an originator, think at a higher level, and fund more loans. And remember, sharing is caring. If you got value from this, I guarantee you a friend of yours in the industry 100% would gain value. If you're listening on Spotify or Apple, give us a 5-star review. And then more specifically, if you are a loan originator or a branch manager who is ready to level up your game, but you don't want to do it alone, you want to shorten your learning curve, you want to learn from real world top producers, I invite you to come check out our coaching. We have 3 different ways that loan originators, mortgage brokers, and branch managers are learning and growing with us. We have our community, we have our boot camps, and we have our elite coaching. Your first step would be to visit our website, which is tloponline.com. That's tloponline.com. Click the coaching button and schedule your 14-day free trial, or better yet, a consultation with one of my team members. I'm Dustin Owen. This is the DO Show. I thank you for tuning in, and I thank you in advance for sharing.